Good morning, everyone. I'm looking forward to talking to you today about DeFi, DAOs, and the decentralized future of finance. So what is DeFi? It's one of these things that's just taking the crypto world by storm. It's designed for direct participation by any user anywhere who's got a wallet. Everything's done peer-to-peer without a middleman or associated fees. Wallet software and other interfaces are available, and the interfaces can hold assets but are often just a bridge between programs. But those middlemen, banks, broker-dealers, lenders, money transmitters, are not needed in DeFi. Decentralization shifts the risk from counterparties to smart contracts. DeFi is built for assets created on or digitized on blockchains, often referred to as crypto assets or digital assets. And blockchain is a database technology that uses digital uniqueness to assure digital assets have value. There's nothing inherently financial to the nature of blockchain or the nature of digital assets. So not every digital asset is financial. And it is the functions and features of each digital asset that determine its utilization, valuation, and classification. And an interesting thing for you to remember is DeFi platforms now permit the mingling of asset types in ways that were never before achieved. So DeFi basically decentralizes traditional financial services, including issuance, stable tokens, debts, securities, insurances, NFTs, trading, decentralized exchanges, derivatives, swaps, prediction markets and liquidity relays, and ownership. Wallets, baskets, fund management, and payment networks. Everything that you can do in traditional finance now can be done with DeFi, but without the middlemen, governed by smart contracts. But what we've seen is an absolute surge in the value of DeFi. So the total value locked in DeFi surged 40 times to 83 billion at the end of December 2020 and has continued to rise in 2021. So what blockchains enable is the creation of smart contracts which self-execute once certain criteria have been met, eliminating the need for middlemen. All you need is a mobile phone. So DeFi is accessible to everyone in a way traditional finance never has been. Now, decentralized exchanges and automated market making. This is a presentation here from Novum Insights, which lists the main decentralized exchanges. So we have Ethereum, Binance, Polygon, Polkadot, Solana. So automated market making opens up new ways of earning returns in crypto. So if you own crypto, you can earn fees from providing liquidity. So the automated market making protocols rely on mathematical formulas and algorithms to price an asset, and then they allow digitized assets to be traded fully automatically without the need for human oversight by using liquidity pools. They utilize smart contracts that, when event triggered, will exchange asset X for asset Y for a preset price based on the reserve ratio of X over Y. So automated market makers have two players, the trader and the liquidity provider. The liquidity provider will first flow a certain amount of tokens into a pool to provide the liquidity and will earn fees paid by the traders. So that all sounds really cool, okay? So you put your money into a pool and then you earn money. But there is a risk of impermanent loss. So as the prices of the tokens held in a pool are determined by an algorithm that adjusts the ratios of the tokens in the pool, if the ratio between the two tokens changes drastically after depositing them in the pool, there could be high slippage. So decentralized exchanges are the place to go if you want to be involved in DeFi. And the biggest ones are Uniswap, MDEX, 1inch, PancakeSwap, QuickSwap, SushiSwap, and Curve. And the pink bars you can see is the total locked value. So Curve is by far the biggest decentralized exchange. And then the lending protocols, so lenders can earn interest on their idle crypto assets, and borrowers can deploy borrowed assets and trading strategies to yield better than the interest rate they pay. So Aave and Compound are two of the biggest ones, the most popular token pools at the moment. So you've got Aave, 12 billion in total locked value, Curve, 8.7 billion of deposits, and Compound with more than 10 billion worth of assets earning interest. And stable coins, and this stable coins are tokens that are backed by some sort of real world asset, generally gold, but they can be backed by other sorts of assets. So they play a pivotal role in DeFi. So USDC, USDT, and DAI are the most popular demanded coins on these platforms above. And what's your risk here? Price risk. The price of the token you put as collateral to take out the loan could drop below the price of the loan. To absorb the market volatility, lending protocols take crypto as collateral asset. They require high collateralization ratios. So yield farming is another one of the marvelous things about crypto is people keep on making up new words. So the yield farming market cap stands at 29.6 billion. So this allows users to be recompensed in return for locking their tokens into a DeFi platform. So you stake your crypto, providing liquidity to a pool in a decentralized exchange, staking the LP tokens, or providing liquidity to lending protocols. So you're incentivized to lock in your tokens or to provide liquidity, and this is rewarded with attractive APYs and sometimes fresh new tokens, which is why they've used the term farming. An important term to know about is composability, which means that different protocols can interact with one another in a permissionless way. So DeFi applications have often got the name money Legos due to their stackable and composable nature. So again, here are some of the key yield protocols with their total value locked. So you've got Yearn, Vault, Alpaca Finance, Alpha Finance, and so forth. But like with all aspects of DeFi and some of these new cryptos, you've got some risks. So risks, you have liquidation risk, technical risk, price risk, and others. So the price of the token you put in as collateral could drop below the price of the loan. The smart contracts could be attacked or could miscalculate returns. An attacker could lend funds on a DeFi platform and borrow back, creating artificial demands and manipulating the token prices. And yield farmers can also make meaningless transactions on DeFi protocols just to interact with the protocol in order to earn token rewards in the hope of price appreciation. So a common safety tip if you want to be involved in DeFi is to ensure the project has been audited correctly before you risk your money. So stablecoins we mentioned before, they have absolutely witnessed hypergrowth with a market cap now of 112 billion US dollars. So the value is pegged to a traditional financial or a pool of such assets like fiat currencies or commodities or gold. So most stablecoins are the ones pegged to the US dollar, a stable global currency. So what stablecoins have done is leverage the benefits of cryptocurrencies, their speed, their low cost, their global reach, but without the price volatility that you see in Bitcoin and Ethereum, for example. So in the time of adverse markets, traders can convert their crypto into stablecoins without potential losses as a store of value in a matter of seconds. So they provide a stable basis for DeFi activities such as saving, borrowing, and lending. So Tether is the most popular, most used stablecoin with a 62.8 billion market capitalization, and USDC is the second with a 25 billion market capitalization. And there's a number of different types of stablecoins that you need to be aware of. So you've got fiat-backed stablecoins collateralized by a fiat currency like US dollar. You've got crypto-backed stablecoins, which are issued on-chain and use over-collateralization to absorb price changes in the crypto collateral. And the most popular crypto-collateralized stablecoin is DAI. Then you have synthetic stablecoins, which provide a valuable mechanism for real-world assets to live on a blockchain in a decentralized manner. And then finally, algorithmic stablecoins. And they maintain the price peg via an algorithm that elastically controls the coin supply based on price changes. And this type of stablecoin addresses inefficient use of capital in crypto-collateralized stablecoins. Now, many of you must have got the excitement of the NFT market, which has taken off with a boom and has been adopted by movie stars and sports players and all sorts of famous influencers. So with a market cap of 15.7 billion, it's a digital file that's recorded on a blockchain and is often used to represent a digital artwork, video, or music file that's sold on an auction market. Tokens can be bought with crypto and resold. And I think still the most expensive NFT ever sold was by Beeple at $69.3 million. So these are serious transactions. So one of the other areas to be aware of with DeFi and what's going on is gaming and NFTs, because NFTs in gaming is absolutely exploding, and it's being led by two companies called Decentralized and Axie Infinity. And I just want to highlight Axie Infinity, particularly given that we're talking to a largely Indian audience, because one of the things that we've witnessed in the Philippines during the pandemic is that Axie Infinity has actually allowed Filipinos to play the game and earn money and keep their families out of poverty. This is huge. So in Axie Infinity, you buy these little creatures called Axies and you battle them, a bit like Pokemon, and you collect, trade, and breed them. And you're able to actually make money out of this. And the company has now started an offshoot called Axie Scholarships. So if you don't have enough money to buy an Axie to play it, they will almost subcontract an Axie to you and you play it on their behalf, and then you split the profits. So this play to earn is going to be a new booming industry, I believe, in developing countries. And I've actually got an NFT project in front of me from some people in India that are wanting to launch it right now. So NFTs and DeFi. So we've got Aavegotchi, an NFT project funded by the DeFi lending protocol Aave, which introduced crypto collectibles. They look like cute ghosts. People pay money for these cute ghosts, and people trade these cute ghosts. So Change Particles can transform your NFT into an interest-bearing token by letting users deposit any ERC20 token into the NFT. And NFTs can also be used as collateral, and NFT-Fi is a platform that allows users to deposit their NFTs, take out a loan denominated in ETH or DAI, and as of the time that I wrote this, a total of 1471 WETH and 1.1 million DAI had been lent out on the platform. So it's early days for NFTs. We're seeing a lot of activity. We're seeing a lot of confusion and a lot of disputes and large crypto transactions. So we expect it's very likely that regulators will move in on NFTs and create limits for big money moves in NFTs to prevent money laundering. So at the moment, the DeFi market is unregulated, but we do not expect that this will continue. So let me talk for a moment about decentralized autonomous organizations. And these are the organizations that generally are used in DeFi to help users transfer crypto across different blockchains and serve popular use cases like crypto lending or yield farming. So they conservatively oversee around $543 million at the moment. But I also want you to note that about 120 million worth of assets were stolen from DeFi platforms in 2020. And one of the interesting features about DAOs is that the company governance and the IT governance is all run by code. These are totally decentralized. There are no trusted human executives. The organization is governed and operated by smart contracts. The smart contracts are written and executed as computer code. The monitoring and enforcement of smart contracts are by computer algorithms. And there are weak or non-existent mechanisms for dispute resolution as the code both governs and executes. So I'm taking you through this fairly fast because of time, but you can see that this is a very exciting space. It's a new and unregulated space. There's no intermediaries to regulate as it's totally peer-to-peer. So how do you stop consumers and investors getting hurt when activities are not controlled, moderated, intermediated, hosted or validated by a single or centralized party other than a smart contract? And it relies on a decentralized governance mechanism such as a DAO, but the actual DAO governance can be opaque. And if you're going to be involved in investing in any of these programs, it would be sensible to have a look at how the governance actually works. So the DeFi platforms rely on open source computer code, and many people pay security researchers to conduct audits of the code to see if there's any vulnerabilities, because unaudited projects are riskier than audited. But remember, just because a project has been audited, it doesn't mean that it's safe. If the smart contract malfunctions, is hacked, or otherwise has a problem, there's no recourse. It's a market that's open 24 hours, 7 days a week. So how do regulators think about activities that cross borders seamlessly and operate on a 24-hour, 7-day-a-week basis? So there's a lot of questions still to be worked out around definitions, developer liability, legal status of code, application of AML and KYC, and jurisdiction, and how DeFi governance is assured, and what are the mechanisms for change. So what are the pros of DeFi? So DeFi can offer greater returns than traditional investments such as bank deposits or investing in the stock market. A DeFi investment plan can be flexible and growth-oriented and ensures efficient asset diversification. The investments are completely automated with smart contracts and zero human intervention, which also means quicker transactions and lower fees due to the absence of middlemen. And DeFi solutions are highly interoperable and can potentially be integrated. And DeFi offers greater transparency as all of the data is stored immutably using blockchain, which can be viewed by the participants anytime and anywhere. But as I've said, there are risks. It's a new and unregulated sector. You can lose money because activities are not regulated, moderated, or intermediated, only driven by smart contracts. And if the smart contract malfunctions or fails or is hacked, there is no recourse. And DeFis rely on this decentralized governance mechanism, which isn't always clearly and transparent. So DeFi relies on open source computer codes, but you need to have security researchers conducting audits of the code to see if there's any vulnerabilities. And unaudited projects are risky, and it is possible for you to go on the internet and have a look and see what projects have been audited and otherwise. And there are people now starting services where expert coders and developers will audit the project or peer review the project for you. So these services and products are available to a global audience, which means it's hard to take due diligence and it's hard to regulate across jurisdictions. And questions remain, as I said, about developer liability, status of code, AML, KYC, and jurisdiction. But one thing is sure, the world has woken up and the world is interested in DeFi, the decentralized future of finance. And what we're seeing is a tremendous amount of institutional investor interest moving into DeFi. And as my last slide, I give this to you to demonstrate that. So Nadine Chakar of State Street, America's second oldest bank with $3 trillion worth of assets under management and one of the world's largest global custodians, said, "The growth in popularity of digital assets is showing no signs of a slowdown, and State Street Digital is committed to continuing to build out the necessary infrastructure to further develop our digital assets servicing models to help meet our clients' growing demands." So no matter what governments think, no matter what regulators think, we are seeing a growth in digital assets. We're seeing a growth in DeFi. We're seeing a growth in institutional investment in digital assets, and we expect that this is going to continue to grow. We are in an experimental stage of this technology, so mistakes happen. We've already seen a number of hacks. We're going to see more. Regulators are going to have to figure out how they regulate something that's decentralized, and they will do that. But what we're going to see is this continued experimentation, because it gives people who haven't had access to the full suite of traditional finance access to it with nothing but a mobile phone. Thank you very much for joining me.